Dear all, welcome back to my YouTube channel, Prassimplified. I'm doing good. I hope you are doing good too. I hope you're liking my videos. Let me ask you an interesting question. How many times do a person needs to pay income tax for an applicable financial year? Everyone tells it's only once. Even I agree with you. But if I ask you, is it that only self-assessment tax needs to be paid while filing return of income, or is there any other interval of time also wherein you have to pay some taxes? Is it that only you need to pay your income tax while filing return of income, or is it that any other person can pay on behalf of you, wherein that amount you can claim while filing return of income? Those aspects I'll be considering in this video. Request you all to go through the entire slides to get a better enhancement of your knowledge. Without wasting further time, let's get into the slides, guys. So let's discuss on the overview of advanced tax, TDS, TCS and self-assessment tax. First, I'll be taking you through the concept of TDS. TDS, nothing but tax deducted at source. So it is nothing but retaining some amount before making a payment to a party, and that retained amount will be paid to the government. What is this? Let's take an example. Let's say there is an employer of Mr. A. While making the payment of salary to the employee Mr. A, and the final tax liability which comes on his total income, let's say 5,000 rupees. What will the employer do now? He will withhold this 5,000 rupees before making payment of the salary to the employee. What does he do after withholding this 5,000 rupees? Once he withholds this 5,000 rupees, withhold in the sense he will keep in his pocket itself. He will not pay that to the employee. He will keep the amount with him itself. And once he keeps that amount with himself, he will need to deposit that amount to the government in the PAN of the employee. Why he does so? Because this will facilitate to get the credit of TDS if the employee is eligible while filing his return of income. This is the simple concept of TDS. So something has to be retained before making the payment. That is nothing but TDS. So now question comes, is it always that actual amount of tax payable itself needs to be deducted? No, there is certain limits and restrictions provided in the Income Tax Act. In case of salary, what does it tell is that whatever the amount of salary the employer makes the payment to the employee, he has to calculate the tax on the total income of the employee which employee declares to the employer. So salary ka detail obviously employer will have. If any other details is provided by employee, let's say house property ka income, or let's say capital gain income, or any other income which employee declares to the employer, those income he will consider while calculating the tax liability, and then he will determine the tax payable. And once he determines the tax payable, he will withhold that amount and then pay to the government. If the employee does not declare, let's say he made some investment in PPF, LIC or somewhere else, he will not give that investment proof to the employer. That time employer will not know that he has made some investment, due to which he will not consider the deduction while making the total income ka computation. Thereby the TDS amount withheld may be higher because he has not given the investment proof. Now what employee can do while filing the return of income, he can claim the actual amount of deduction with that investment proof, and thereby file his return of income. Thereby whatever the excess amount of TDS is deducted, right, since it is declared in the PAN here, that is employer pays the amount of TDS in the PAN of the employee to the government on behalf of employee. Hence thereby this credit will be available to the employee in the portal, and thereby this credit can be taken by the employee. Now let's say Mr. A, an Indian resident, earns an FD interest of say rupees 50,000 in a year. Applicable TDS rate is 10% as per the Income Tax Act. So what will happen? Whenever the bank will make the interest accrual, that is interest is credited to the bank or credited to the FD statement of the employee of the taxpayer, what happens is that the bank is under an obligation to deduct 10% TDS, because the TDS sections tells that if the interest amount of FD exceeds 40,000 in a year, you have to make a TDS. But if it's a senior citizen, the applicable limit is 50,000. But let's assume he's a normal citizen and he's not a senior citizen. Senior citizen in the sense 60 plus years. Okay, let's say he's a normal citizen. So 40,000 is the limit. So since the amount is 50,000 rupees which is paid, 10% TDS needs to be deducted. Therefore, 50,000 minus 10%, which comes to 45,000. Only 45,000 will be credited to the bank account of the taxpayer. Rest 5,000 will be paid by the bank to the employee's PAN on behalf of to the taxpayer's PAN on behalf of the taxpayer to the government. This again can be claimed as credit while filing the return of income by the taxpayer if he is under the nil tax bracket. Next, why is this TDS to be done? Now we will obviously pay the self-assessment tax while filing the return of income, right? So why this TDS needs to be done? Question comes into picture. So these are the reasons. One is that government can keep the track of income of the income recipient. And income recipient will file a ETR at least to claim the TDS as a refund if he finally has no tax payable, right? So thereby he'll file his return of income, which will encourage the taxpayer to file return of income, and thereby the government's objective is achieved. Next one, while filing such return, he also needs to show that interest on FD, let's say in the last example I have taken FD, interest income, right? So that interest income he needs to show in his ITR, because now 10% TDS means what? 5,000, right? So 5,000 divided by 10%, which is 50,000 income you have earned. Government will know that. So if you do not show 50,000 as income, government will immediately send that automated notice will come from the department telling that you have not shown appropriate income, though TDS amount is this much. So government knows the amount of income earned. Next one, in a way it is also helping the government to receive the funds in advance, because TDS happens as and when the interest is credited. Let's say it gets credited in September itself. So he need not wait till you file the return of income. He'll get immediate amount. Government will get immediate amount. Next, so one is the TDS. Now next is TCS, tax collected at source. So what is this meaning of tax collected at source? Collecting something extra amount by the seller from the buyer. Example, let's say a car is sold by a car showroom to Mr. A for rupees 15 lakh. TCS applicable is 1%. Now car showroom has to collect 15,000, that is 15 lakh into 1%. 15,000 extra from the buyer apart from 15 lakh, and this amount he has to pay to the government in the PAN of the buyer. Now Mr. A can claim this while filing return of income. Now why is this kind of TCS concept has been bought by the government? This is because, see, the quantum of expenditure incurred by Mr. A is huge, right? So 15 lakh of car he has purchased. Now if he does not show that in his return of income as an asset, so how will the government know that this person has purchased a car? So government has introduced this provision that if you purchase a car exceeding 10 lakh rupees, 1% has to be deducted as TCS by the car showroom itself. So 15,000 will be withheld. Now withheld and paid to the government, this 15,000 can be claimed by the car owner while he files the return of income. Simple. Next concept is advance tax. Who has to pay this advance tax? Not the third party. The taxpayer himself has to pay this advance tax to the government. How? Let's take an example. Before that, I'll tell you what is advance tax. So whatever is the estimated final tax which you have to pay in advance by the taxpayer for a financial year that is prior to 31st March of the respective financial year to the government. In short, from 1st April to 31st March, whatever income you earn, you have to estimate that income in advance and determine the tax liability and pay to the government. Now, in what installments you have to pay, that I'll be telling you in the next slide. Here it is. So if you are earning income on or before 15th June 2021, you have to estimate firstly you have to estimate the final tax payable. Now what is meaning of final tax payable? It is nothing but first you have to estimate a total income for the full year. Calculate the tax on that income as per the applicable slabs. Post that, you have to deduct whatever TDS or TCS has been deducted. Let's take an example. If tax on estimated total income is rupees 25,000, TDS is 2,000 and TCS is 1,000. Final tax payable comes up to 22,000. Why? 25,000 minus 2,000 minus 1,000. So 22,000. Once you determine this you have to pay in installments. How installments? You have to follow this table. On or if you are falling on a date on or before 15th June 2021, at least 15% of this amount, that is 22,000, you have to pay on or before 15th June. And on or before 15th September, at least 45,000 you have to pay. 45,000 you have to determine, then whatever you paid earlier in the first installment you have to deduct and balance you have to pay. On or before 15th December 2021, you have to pay 75% of the final tax payable, and on or before 15th March 2021, 100% of the estimated final tax payable you have to pay. Okay, minus whatever paid in the earlier installments. Now, government has also given a relief that in the first and the second installment, instead of 15 and 45%, you may pay 12% and 36%. This is a relief given to the taxpayers. Now, there are certain exceptions, the consequence of non-compliance and the non-applicability of the provisions, which I'll be taking in the upcoming videos. Next is self-assessment tax. This tax is nothing but which is paid post the financial year, because during the financial year, if you are paying, it is nothing but advance tax. But post the financial year, up till the return of income, whatever tax you pay, it is called as self-assessment tax. This tax you have to pay before filing the return of income in the income tax portal. So this was it for today, guys. Hope you liked my video. If you're really interested in the next video which I'm going to do, please do drop a thumbs up in the comment section. Thank you guys and have a nice day.